Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to the show, Danielle.
Thank you, Jim.
Danielle, the Bank of Canada is missing a magic bullet, as you posted in your blog. The Canadian economy is slowing down. Can the Bank of Canada do anything about that?
Well, I think it's going to try and cut rates again in 2020. Possibly, I would say, I would see it as something that Mr. Polos wants to do on his way out on June the 3rd, if not before then. But if you look at their release yesterday, their prospects of growth have been ratcheted down again, and they said they're watching the global developments to see if this is a persistent trend or if it's going to shake off. So, we're looking at a growth trend over the last quarter of 2019 that was barely 0.3, according to the best guesstimates at present, and they were hoping that we'd get something like 1.3 annualized growth in the first quarter. But overall, things are looking really tepid. And so, again, the Bank of Australia held tight. The Bank of, most banks lately haven't been cutting rates, but central banks, but it's because they're basically already near the bottom end of their comfort zone, with very little room to go there. And so, again, as we've discussed, the Bank of Canada looks at the Canadian households, and, that recent survey of MNP, which I also put on the blog, who found that half of Canadians on the verge of insolvency. This goes back to our friends at Hoyes Micheloz and other trustees in bankruptcy in Canada who are just having a banner run in their business right now with, double-digit growth month after month after month. And this is just Canadians coming in finally, often after a year or two of being technically insolvent and just crying uncle and saying, fine, I can't keep up this charade. They're robbing Peter to pay Paul from one credit card to the other, their Helco balances, and then, of course, banks aren't making it as easy to borrow on lines of credit anymore. They're getting more picky. You've had a sort of leap in costs, in insurance costs on a lot of the floating lines of credit, and all that has just pushed everyone right to the very max. In the survey, they found that half of the people didn't have $200 extra if some major event or, problem or lost work or a car problem, any of that happened, they would be just pushed over the edge. So, that's where you've got very little resilience in the household. And I think that's what the Bank of Canada looks at. They're saying, we know that housing, as an example, residential spending, residential investment, they call it, which is basically, new construction, but also renovations, fix-ups, appliances that you purchase, and brokerage commissions in the residential sector. That's amounted to about 7% of our GDP for the past several years and has driven pretty much all or most of the growth we've seen in the Canadian economy, even though it's been muted for the last decade. Well, the problem is that's about, almost 60% of our overall economy right now. It's horribly concentrated in that one sector, and the long-term trend that's sustainable of that spending or investment in that particular residential real estate sector, Jim, is supposed to be more like 3% of GDP. So the fact that we've got 7% today is like obscene. And if you look at a chart of the U.S. experience in their housing bubble into 2005-06 when it peaked, indeed it was, it came down as well into that sort of 3% range before and stayed there for several years, P.S. This is the other thing that people don't appreciate. These trends are not something that it'll take a couple of months for people to get their savings back in order, to pay down debt or go through insolvency to get debt ratios down. It's not going to take a couple of months. It's going to take a period of years, right? And so when we've seen even the Bank of Canada mentioned the rebound in housing, that was kind of like the one bright light for Canada in the past few months. But again, it's the same as what we're seeing in the U.S. right now. It's driven primarily by investment, people going in looking for properties to buy, but not by people who can afford to buy them as shelters and live in them themselves. Those folks are still marginalized and having a very rough go with unaffordable costs and stagnant wages and, now leaping interest rates, as I said. So all this is just sort of, although, it propped up Canadian growth to have a return to the residential sort of fever and speculation in major markets in Canada in the last few months, it's short-term helpful and longer-term destructive again, because that's the opposite of what we need. What we need to see, and Mr. Polo's touched on it, is we need to see a rebound in business investment. And we don't mean share buybacks in this. We don't mean borrowing more debt to buy back your shares and push up your executive compensation. What we mean is literally in new business models and lines and systems. So you think about all the huge areas in the world which are just screaming for capital right now. Whether it's in renewable energy, whether it's in electric vehicles of all kinds, planes, trains, and automobiles, rebuilding infrastructure, all sorts of wonderful things going on. But that's not where the capital is flowing right now. The capital has been flowing into financial speculation, driving up the price of assets, which has basically become like a big Ponzi scheme, and that just makes it that much more precarious. Everybody's hoping, this is a classic plan, and it was mentioned yesterday in the BOC's thing, everyone's hoping that they'll be able to, double down on exports, that somehow, even if their economy is weak domestically, they'll be able to get a bunch of stuff sold to other countries. Well, we're just not seeing that in the data. We're seeing that trade numbers are way down, Japanese numbers were way down, Indian economy is slowing, Jim. That was a sort of a, can't lose bet in the past few years. The 1.3 billion people everyone talks about, that growth rate was at something like 8% in 2017, and recently they're forecasting the lowest since 2009 in the recession of possibly 5% growth. And there's a lot of other people that are looking at the numbers in terms of the electrical consumption and the actual activity that one can observe within the domestic economy and just saying, yikes, it's probably less than 5%. So this is supposed to be, the fastest growing economy, and it's having a hard go too. Its exports are faltering as well. So you can just see that there's a problem with funding in the world today, right? And it's a function of overcapacity, overbuild out, too much credit, too much speculative activity, making a bunch of imprudent allocation decisions, which have not helped productivity. Canada's productivity has been stagnant. GDP per capita has been literally stagnant for a decade, Jim. So with all this frenetic activity going on, we aren't really making any progress. As I saw someone on Australian news speaking the other day, and he was saying, that they've driven up the price of their homes and sold expensive homes to one another and tried to convince themselves that that's prosperity or that that's wealth or that they've made progress. But in fact, all they've done is made their shelter more costly and their living less affordable, and their ability to save that much less, and their productive investment in things that will actually improve the future have not been kept up. So they've got holes and deficits everywhere, just at a time when all this innovation and new investment is needed to transform the economy into this new, industrial revolution for the 21st century, which is what's already underway. I mean, it's been happening over the last 20 years. It certainly was happening, in the 2010 to 20 period, but then again, a lot of financial speculation and waste has really led to a stagnation now. So it's going to be very interesting to see. I can see lots of positive things happening, but we've still got this massive financial Ponzi going on, and central banks pedal to the metal, pumping liquidity in, which, they're telling themselves, I suppose, that that's essential to keep stability, but really all it's doing is, funding hedge funds and other speculative players at the expense of savers, at the expense of productive investment. So it's really very long-term destructive.
We'll have more with Danielle Park right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Danielle Park. Danielle, should the Bank of Canada and other central banks boosted interest rates back, say, 2 or 3 years ago when the economies were doing well so that they would have some wiggle room for when times got tough?
Well, it's so convoluted and messed up now. It's not just even a function of their interest rate level, right? They're doing so many experimental daily interventions. There's no free market concept anymore. They won't they don't want any asset prices to go down because we've got such a highly levered economy on these asset prices. And so all they're doing is really catering to the speculative class, not doing anything productive, as I said, and we've got all these areas screaming for serious investment. But this is investment that doesn't just, trade in and out on a day-over-day basis. These are longer-term investment themes. So we were talking about, before the call, about some of the really cool things that are going on. So, even legacy companies, like, for example, the oil and gas sector, as you know, has had a hell of a go in Canada. It's been the worst performing sector for the last decade. The price of the energy producers as a sector is down 57% from where it peaked several years ago. It's just been annihilated. Now what we're seeing is a big jump in defaults in the sector, because if you remember back in 2015-16, we had the big oil shock, the price of oil crashed, and a lot of companies just borrowed more money at that point in the hopes that by the time these loans came due in 4 or 5 years, the price of oil would be back above $100 and they'd be away to the races again. Well, as you know, that has not happened. Even with this latest surge of stress in Iran and Middle East, and everyone was hoping that would be a new, prop under the price of fossil fuels. In fact, we see that was very short-lived and that it's been crumbling again. So today we've got, Brent crude back under $62, and a lot of these companies have used forecasts. Just take Brent, the European equivalent, as an example. They've forecast $75 to $90 a barrel as the price range, even though it hasn't been there for 5 years at all reliably. And even though, so what's happened is they've got all these assets on their balance sheet which are overvalued, assuming a price which is nowhere close to where we are right now. Not only that, but when they do go to sell what they have, they've got a lot less cash flow than they'd hoped. And they've got this debt now coming up for renewal. So this is a big issue, right? Because the money they borrowed in 2015-16, as it comes due now in 2020-21, the price of interest or the cost of borrowing has gone up considerably. So while the stock market's been bubbling away and acting as everything's fine, we've seen a lot of cracks and crevices happening in the credit markets, which is why the central banks have stepped in the past few months to start injecting more principal. If everything was great, they wouldn't need to be doing that, but they're doing it almost on a daily basis. So what that really does is sort of try to cover up this deep distrust and seizure which is happening in the overnight markets, but which is happening in terms of corporations lending to one another, in terms of financial institutions lending to one another. This is all kind of very reminiscent of what we saw in 2007, leading up to, in the spring of 2007, things were really starting to unravel. There was a lot of the seizure in the same type of money markets, and it's very reminiscent of that. So it speaks of this, again, this Looney Tune amount of debt that's been issued at very ridiculously low rates that didn't reflect the credit risk involved. And now you've got these defaults really spiking. And they won't be, of course, just in the oil and gas sector, because you've got a lot of other feeder sectors and services and, consumers and all sorts of things that are tangential or tied to that same sector. So it's not a good story by any stretch. Just at a time when investor capital in the world, as you know, if you've been following major stories, whether it's BlackRock, whether it's Norway's investment fund, whether it's a Canada pension plan, who have all added new targets and financial disclosure requirements of corporations to say, hey, what price have you got for example, your carbon emissions? We've got new carbon taxes coming in. We want more disclosure on your risks. What are the assets? What are you valuing them at? What are you likely to have to write off? And that's already happened, right? So we've seen several of the companies, even last year, starting to write off billions of dollars in notional value from their balance sheet. So this is, a crunch that's happening for secular reasons. This is not a cyclical turn-down blip thing. This is a persistent secular shift. And it's causing credit strain throughout the Canadian economy, and it's going to continue to spread. And the fact that we've got jubilant, stock prices just means that the mean reversion phase, the correction phase, the sobering thing is going to be that much worse. Now, they may hold it off a while longer. A bunch of people have been sort of ratcheting down their expectations for when a recession may be coming again. They're thinking maybe this free money will float the thing a little longer, but it may do. I mean, we're already the longest expansion that we've had. We're certainly due for a recession in normal conditions, but when you look at this disturbing, massive amount of credit, both in the household sector, as I say, and in the corporate sector, already the number of defaults is up 50%, according to J.P. Morgan, in terms of year over year. And the number of distressed increases, exchange increases, is up by 400%. You've got this, more junk debt now than you've ever had in any other cycle. So it's a house of cards, and unfortunately, the longer the prices hold up, the more people are vulnerable to being sucked into it, the fear of missing out. And that is all kind of classic behavior, because if you think about it, we've got these really massive secular shifts, as I said, undergoing in the world. These are legitimate investment themes. Massive. They're going to be, here for the next several decades. They're going to shift the world. The world of 2030 is going to be fundamentally different than the world of 2020. And you can see that already if you open your eyes and look around. But, getting from here to there in terms of the financial write-offs, the defaults, the losses that are going to have to happen to industries and investors that are not paying attention, that are not seeing the transition, is going to be really significant.
We'll have more with Danielle Park right after the break.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Danielle Park. Danielle, how will 2030 be so much different than 2020?
Well, You can see some of the themes. As I say, this migration towards renewable energy, that is no longer at all fringe. Every major CEO of a major oil company has admitted that there's this connection between emissions, methane and carbon emissions, and the climate change and catastrophic events that we're seeing around the world. So it's no longer a matter of, whether you believe or don't believe. The fact is the people producing the emissions have all admitted, of course it's connected, but basically they're saying, and fair enough, they're saying, we've known this for years, but no one seemed to care. No, governments weren't that concerned. Consumers weren't that concerned. No one seemed to mind. So we just doubled down and made a ton of money. Fair enough. But now they are admitting, and even the head of Shell was saying recently, clearly there's a big change afoot in the world, and it's no longer business as usual. So in that environment, all of the focus is going, for example, you saw Petro-Canada this month finished a build-out of its network of EV charging stations all across Canada. That infrastructure is now in, Jim. Shell is building out its own network. Canadian Tire announced this week that it's going to build 240 new fast chargers and 55 other types of chargers at 90 different Canadian Tire locations across the country. So, you've got Fiat Chrysler announcing they're doing a joint venture with Foxconn, the iPhone assembler in China, to build electric cars and interconnected vehicles. It's just like everywhere you look, this main theme. At the same time, there's a lot of talk of there's electric, there's fuel cell buses, and there's, which is Ballard Power's thing, right? They've been doing that for decades, actually, but they're in high demand now all over the world. More buses and heavy equipment for, trains, planes, and automobiles, basically. And you've got EVs for, you've got Damon Motors in Vancouver that's producing this really cool electric motorcycle that everyone in the world is interested in. You've got, as we've talked about before, BC's Harbour Air is, turning in, using the Magnix electric planes to transition its flight. So you've got this theme everywhere, and there's more of that to come. Because 10 years ago, people didn't think that was going to be possible at all, or they poo-pooed the whole idea. And now it's just every day you're getting a new news story, right? So it's more of that, I think, and there'll be all sorts of cool ideas about carbon sinks. Like, for example, the UN just came out with a big report saying that we can use a lot of the denuded land to restore it, to be, whether it's for growing plants, whether it's growing trees, basically turning it back into a natural carbon sink for a relatively modest investment globally, and that could take 20 years of current emissions already out of the air and buy us some more time as some of these other technologies start. So I think you're getting a lot. I mean, building sector is going like gangbusters in terms of efficiency and new product types, new ways of building properties. You got world-class architects all over figuring out whole new ways to go about it. That's just so much more efficient. So it's a massive turning point. It's a very exciting time. And those are all legitimate. The problem, again, is if you're looking at it as an investment thesis right now, you've got things like Ballard Power, great technology, stock trading at something like 20 times revenue, not earnings, like just predicted cash flow. So as if, every dollar that the company brings in over the next 20 years could be given to the investors and nothing spent on running the company or innovating the products, So it's just, we're in this, as I say, lunatic fringe investment environment. And if you can just not lose your head in this, keep your liquidity, don't do what the herd's doing, don't have tons of debt, keep your liquidity high, don't get over levered, don't get sucked in. Just allow yourself to do your homework, to look at where the puck's going, to figure out where these trends are going to advantage, in terms of good revenue growth or, in terms of bringing down the costs for real life people. That's where the money's going. And institutional money's going there, pensions are going there. But again, pensions have 40-year time horizons plus. If they start feeding into some of these areas and they face a big washout in the next couple of years, they're just going to continue trying to keep building that that portfolio. But as the head of the CPP said, this week in Davos, the average person doesn't have that kind of time horizon, so they have to be a little bit more concerned. It's not really a risk profile that you can afford to take. So you have to be more conservative in how you go about it. And that means you sort of have to wait for some kind of washout to come, in which case then you're going to get, opportunity and yields that are really be compelling and worth having probably for the next decade.
Danielle, is there kind of a cutoff point when a person is nearing retirement age where forget about risky investments, just put it into cash or GIC so you're not going to lose your money?
Oh, for sure there is. I mean, there needs to be, it's all a function of your time horizon, right? So as you go, you have to be realistic. Like if you're 50, and you're hoping to be retired in 10 years, then you can only afford to take risk with some of the money, and the rest of the money has to be kept pretty liquid and safe, GIC deposits, government bonds, things like that. As you get into retirement, 60, 70, 80 years old, you really don't have, the kind of environment I'm speaking of is a thing where the prices of the current assets could do something like they did in the late 20s, in the 70s, even in the late 1990s, where prices correct significantly, like 50 to 80% style declines, and then stay there for many years. At that point, the people that are currently holding them will realize that they didn't have a long time horizon, that they were trying to take income in the present or in the near future, or they just didn't have the ability to ride out that kind of a massive downturn for that long. Whereas the people who are able to pick up assets up in that environment will be able to have a fraction of the volatility and downside risk, but also have higher income. But even at that point, you have to be very careful about how much of your savings you can afford to put into something on a longer term view and how much of it you need for living expenses in the present. And that is something that many people don't do enough work on before they just start buying things.
And Danielle, before we go, we have a question from a listener. Danielle, I've read with great interest your posts over the years on Howe Street and also Juggling Dynamite. I've always found your posts to be very informative as well as educational and have been a great help to me in terms of considering all factors in investment and not blindly following the herd. Their question, what do you think of the precious metal sector going forward in terms of hedging risk and or investment return versus the equity markets?
Okay, so as a hedge, a bullion, or if you want to have coins or bars, that sort of thing, you can have that. And now, I've written a pretty detailed post on this in the past, and I always direct people to it. It's called A Word to the Gold Bugs, and I invite you to look that up on the blog. In the search bar, you can put A Word to the Gold Bugs. But basically, it just goes through in detail my thoughts on gold, where it's useful, and where I think people make mistakes in terms of their presumptions about it as an asset class.
And Danielle, you're also pretty excited about what Starbucks has just announced.
Oh, I was just mentioning to you yesterday they had a large policy change in where they announced that they're going to again, you speak about what's going to change in this next decade. A lot of companies like that are coming forward with their policy initiatives saying between now and 2030, starting right now, we're going to work towards having zero plastic waste in our restaurants. We're going to go to reusable containers, which is a huge development. We're also going to do a 50% decrease in our energy use, as well as, in their case, they're going to bring in vegan options, plant-based food options to their restaurant. So these are, again, just typical playbook of what a lot of companies are responding to, both investors who are concerned about unsustainable models and customers who are saying, hey, I don't want to have to keep getting this garbage when I pick up your product, or hey, have you thought of giving some options that don't include animal products? And all of that is sort of part and parcel of this push for greater sustainability.
Vancouver banned styrofoam fast food containers starting, with the new year this year. Is that a trend that you're seeing?
Absolutely. Lots of cities. Now, also, municipalities are doing things like starting to ban natural gas hookups in new construction. San Francisco just recently did that, but they're not the only one. So again, thinking far-reaching. What is a lot of oil companies, if you read their prospectus, they're looking at this diminishing demand cycle, and they're realizing that their product's becoming less palatable and desirable. But their plan is often to switch to increasing plastics. I've seen many of them say they want to increase their petroleum plastics by 50% over the next decade to offset the loss on the transportation and fuel side, and also to go into things like natural gas. Unfortunately, plastics is on the way down as well, and more and more places are banning them and curtailing their use, and more companies are now signing on. At the same time, you have, as I say, a lot of places starting to understand that natural gas has more methane emissions, which are 80 times worse in terms of warming and persistence in the atmosphere than carbon. So, we have to be realistic. If you're shifting your business model to something more sustainable, you have to look at where that's going to be, palatable, feasible, and not just another area of problem.
Is the slogan, act locally, think globally, really becoming reality?
I think people are just thinking more locally, period, right now. I think they're pulling in. There's a lot of concern. I mean, things like this SARS virus or the new version of it just reminds people of the risk. And you can argue that it's bad and self-defeating, but the reality is there's a pulling into local focus right now to rebuild coffers, but also just because people have fear and uncertainty about jobs and income. And so that's why you're seeing this pullback in trade all over.
I was almost thinking about starting a food bank here in my condo tower. We must have people here who, being on fixed incomes might find it a little tight at the end of the month. Should people be thinking about things like that?
Well, absolutely. I think in communities, people should figure out how they can help each other and themselves. I mean, unfortunately, food banks are booming all over the country, and they've been on a big growth trend for the past 20 years. And that's a function of, as I say, just not enough resources to go around once people cover things like shelter, which have had an extremely, unaffordable increase. So it just means there's a lot of stress and strain through households in general, and things like food, which, you have to have, but the quality of the food is suffering. And that ultimately comes back to higher health costs for us. Right now there's a bunch of concerns about deficits in healthcare spending, in education spending, in correctional facilities. Everywhere you look, there's reports on not enough funding going into the system. Part of that has been this huge downturn in corporate tax rates over the past couple of decades. And I think, in the next recession, the impulse is always, well, let's cut corporate tax rates some more. I think we're in a very different environment when corporate tax rates are already at, decade lows than when they were at high rates, and you had more meat on the bone there as well. So I don't think that's going to be the go-to solution. And in fact, I'd say tax rates are very likely to go up.
Thank you so much for being on the show.
Hey, thanks, Jim. Talk to you later.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. She's president of Venable Park Investment Council Incorporated. Her website, jugglingdynamite.com. If you have any questions for Danielle, as you just heard, we do answer them. You send them to info@howstreet.com. Find us on Twitter @HowStreet, our YouTube channel, Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.